Okay, picture this. You're trying to compare the performance of two massive multinational corporations, right? One is headquartered over in Tokyo and the other is sitting in New York. Without a standardized, meticulously defined language, figuring out which company is actually healthier, it's practically impossible. You'd be completely lost in a maze of different accounting treatments and local customs. And that is exactly why International Accounting Standard 1, or IAS 1, exists. It acts as the ultimate universal blueprint for presenting financial statements. Welcome to this explainer. Today, we're going to decode this foundational document and see exactly how it forces companies to lay all their financial cards on the table in a way that investors worldwide can actually understand.
All right, let's dive right in. Here's our roadmap for dissecting this 40-plus page regulatory rulebook. We'll start with the language of business, move into the complete financial set, explore the core rules of presentation, examine the mechanics of classifying assets and liabilities, and finally, look at the fine print where the real story hides.
Section 1. The language of business. The evolution of universal accounting rules. Let's look at the foundation. Now, what's actually kind of fascinating here is that this standard, it's a living, breathing document. Look at this evolution. IAS 1 was adopted back in 2001, but it didn't just sit collecting dust on a shelf. It was revised in 2007 to refine terminology, and then by 2014, the Disclosure Initiative stepped in to clarify how management uses judgment. Then, major updates hit in 2020 and 2022, specifically targeting how companies classify debt. It's constantly evolving, just closing loopholes and creating crystal clear transparency. So, why all these updates? Well, it all boils down to one massive concept. As the standard explicitly states, the goal is to ensure comparability both with the entity's financial statements of previous periods and with the financial statements of other entities. Comparability is absolutely the overarching goal of IAS 1. It literally ensures we aren't comparing apples to airplanes. Whether you're looking at a company's performance this year versus last year, or you're comparing a massive tech giant to a local manufacturing firm, IAS 1 ensures that the basic structural framework is identical.
Moving on to Section 2, the complete financial set, the ultimate toolkit for financial transparency.
Look, under IAS 1, a company can't just hand you a slick summary of their profits and call it a day. No way. A complete set of financial statements actually includes several pillars: the statement of financial position, profit or loss, changes in equity, cash flows, and crucially, the explanatory notes. Plus, you need comparative info from the prior period. What's absolutely vital here is that IAS 1 dictates all these statements must be presented with equal prominence. So a company cannot just bury its balance sheet to highlight some flashy profit report.
And the gravity of these documents, it really cannot be overstated. While the main statements give us the hard numbers, the actual rules dictating how those numbers are derived are deeply, deeply technical. As noted in the standard itself, all 140 paragraphs of IAS 1 hold equal authority. You can't just pick and choose which presentation rules to follow. They must all be read in the context of the overarching conceptual framework for financial reporting.
Which brings us to Section 3, Core Rules of Presentation, the philosophical foundation of reporting. First up, we have materiality. Basically, information is considered material if omitting it, misstating it, or even just obscuring it could reasonably be expected to influence the decisions of primary users. This rule exists for a very specific reason, so investors aren't completely drowned in a sea of useless, immaterial information. I mean, if a company overdiscloses tiny, insignificant details, they might actually be obscuring the real financial reality. IAS 1 specifically warns against reducing understandability by hiding material facts behind immaterial clutter. Now hold on a second, because I really want to slow down here. This next concept is absolutely vital. Going concern. This is the assumption that an entity will continue trading and operating normally. Management is actually required to assess this by looking at all available information at least 12 months into the future. If management determines there are material uncertainties, or worse, if they intend to liquidate the company, everything changes. If a company is not a going concern, the entire financial blueprint shifts away from normal operational accounting straight into liquidation accounting. It's literally the fundamental pulse check of the business.
The final core rule is the accrual basis of accounting. Outside of the statement of cash flows, an entity has to prepare its financial statements using the accrual basis, meaning you recognize items as assets, liabilities, equity, income, and expenses when they satisfy the definitions and recognition criteria, not just when cash actually changes hands. It ensures the statements fairly present the financial performance as it is actually earned or incurred during that period.
Section 4. Classifying assets and liabilities, the mechanical engine of the balance sheet.
In the world of IAS 1, there's a magic number that dictates almost everything about how a balance sheet is structured, and that number is 12. 12 months. It defines the assumed normal operating cycle if one isn't clearly identified. It dictates the classification of liabilities, and as we just saw, it's the minimum horizon for assessing that going concern assumption. So how does that 12-month rule actually play out in practice? Well, IAS 1 forces companies to divide their balance sheet into current and non-current classifications. Current means assets or liabilities expected to be realized or settled within 12 months. You know, the net assets continuously circulating as working capital. On the flip side, non-current encompasses everything else, the long-term infrastructure and debt not due within a year. It essentially separates today's immediate operations from tomorrow's structure.
But it's not always super straightforward, especially when we're dealing with debt. Let's walk through these strict steps regarding loan covenants. Step 1, the company has to assess if it actually has the right to defer settling a liability for at least 12 months at the reporting date. Step 2, they have to see if any loan covenants affect this right. And step 3 is where it gets highly regulated. If a company breaches a covenant on or before the reporting date, making the loan payable on demand, it must be classified as a current liability. So here's the crucial point. Even if the lender agrees to forgive the breach after the reporting period, the liability still has to show up as current on the balance sheet. Why? Because at the exact date of reporting, the company didn't have the right to defer it. It's an incredibly strict rule designed to ensure total transparency about short-term risks.
Finally, Section 5, the fine print and notes. This is where the real story is hidden. While the main financial statements give us the architectural framework of the business, the notes provide the necessary clues for our detective work.
For instance, let's look at how a company reports its expenses. IAS 1 allows manager a choice between two presentation methods. They can present by the nature of expense, grouping things by type, like raw materials or depreciation. Or they can present by the function of expense, classifying costs by their role, like cost of sales. Now, if management chooses that function method, IAS 1 mandates that they must provide detailed disclosures about the nature of the expenses in the notes. Why? Because knowing the fundamental nature of costs is highly useful for predicting future cash flows.
And beyond just expenses, these notes are literally an absolute goldmine of required disclosures. Companies must disclose their material accounting policy information. They have to explicitly lay out the major judgments management made when applying those policies. Even more critically, they have to disclose major sources of estimation uncertainty, meaning assumptions about the future that carry a significant risk of requiring a material adjustment to asset or liability values in the next year. They also have to detail their capital management objectives. Basically, these notes contain the major assumptions about the future of the business, and they are critical clues for any investor analyzing the true stability of the company. Which brings us to our final question. What is the true health of a business? IAS 1 provides an incredibly robust, universal blueprint to help answer exactly that. It ensures comparability, enforces strict rules on current versus long-term health, and mandates that absolutely no material fact is obscured. But remember, IAS 1 only provides the plans. It's up to you to read those plans, dive into the notes, and uncover the truth. So the next time you're handed a pristine, highly polished corporate balance sheet, you have to ask yourself, what story are the numbers really telling? And more importantly, what secrets are buried deep in the fine print?